All right. Welcome, Frida, and welcome to those of you who might be listening to this later to week 3. We're already more than halfway through Finance 444, which is incredible when you think about it. It seems like we just barely got started, um, and we're almost done. So, one quick, one quick, one quick housekeeping issue for this week. This coming Monday is Columbus Day. We will still hold the class Monday night on the 10th. So for those of you who sometimes assume that we won't be holding class on a holiday, we will. I'll be anxious to get that done and get you ready as soon as possible for the final. So we'll get that recorded and done so that you can get a start on that final week assessment. So anyway, tonight we're going to cover chapter 11. Last week we had a couple chapters. We had basically a case study. This week for the assignment we have a case study as well. If you have any questions or concerns on that, it's number 2. It's a financial planning. It's basically an investment planning case study, it's number 2 at the end of chapter 11. Like I say, if you have any questions or concerns with it, let me know. But hopefully that'll be pretty straightforward like the last few weeks have been. Having said that, the last couple of weeks we're missing a good handful of assignments. And not that we're missing more than normal. I mean, out of 20 plus students, I'm probably missing 6 to 8 of the week 3 assignments, which having about a third of them missing may sound surprising to some of you who are always turn in your work on time. But for me, after teaching for 6 years, that's fairly standard. That's fairly typical. Having said that, about half those folks will never turn in their assignment and they'll fail the class because of it. So I know that sounds like a grim report or a negative to start off on today, but I do want to strongly encourage those of you who are a little bit behind at this point, don't have your assignments in, to go in. They are short case studies. They are not long, drawn-out math problems or long, drawn-out essays. These assignments for this particular class are some of the easiest points that you'll get. You know, it's relative to other courses that I've taught. This 120 points that this class offers from the assignments is pretty straightforward, pretty easy. Yes, you still put in effort, but it's not nearly as hard as some other classes that I've taught. So please, 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 if you find yourself behind, make sure and get caught up this week. Use week 3 as a good week to get caught up. Don't wait till next week. It seems like every single course, people wait till week 4 and then things go wrong, right? Frida, I don't know if you've ever had this happen with your online courses, but I know when I was taking some online courses, if I put off and procrastinated assignments or assessments until the very last minute, it always seemed like some emergency with my family happened, some health issue happened, some computer problem. I mean, there's just a million different things, right, that can go wrong and create a situation where you don't get through the course if you wait and procrastinate till the last minute. So, and Frida is an excellent student, so if it can happen to her, it can happen to anybody. So having said that, I just, take it for what it's worth. I just strongly encourage you to try to get a head start on it this week. Get caught up the best you can. Know that these assignments are not horrible. They're not terribly difficult. If you have a half an hour or an hour's time at some point, get on it. Get that thing done. Get it knocked out so that you don't find yourself scrambling, next week without being able to get completed and get through the class. You all are spending too much effort, time, and money to not pass these classes, right? We want to make sure that you get through all of them. I'll do anything I can to support you in that, but I have to see effort from you in order for me to reciprocate and be able to help you along. I'll spend whatever time we need to do one-on-one, answer any questions that you have via email, anything like that to make sure that you can get through the course and get it passed. So just let me know, though, sooner than later. Don't wait till Friday or Saturday next week to be in a panic mode and then not have access to me. So please get on it. Get with Lindsay. Get with myself. Whatever you need to do. Okay. All right. Discussion board. Another great week. Most of you participated. That's great. And the assessment looks like the average score was a 70 to 80%. So that gives you a feel. If you got above an 80%, you're above average on this particular test. If you got a 70, you're right about where most people were, getting 35 out of 50. So there must have been 2 or 3 problems on that test that were pretty tricky. We've got another 10 problem assessment for this week. What that makes me think is either 1, people aren't reviewing the session to get the information, or 2, there really are some pretty tricky questions. Now, what do we need to do to kind of overcome some tricky or strange worded questions? We just need to take our time, take a deep breath, reread the question and the answers. Don't go with our first choice until we've reread the question, because sometimes it's just a situation where we're a little too hasty in how fast we accomplish the test, and that it bites us, after we submit. All right, so that's last week. Another quick issue from last week. I went out of town Friday and Saturday to be with my parents up in Franklin, Idaho, which, for those of you who are not familiar with Franklin, Idaho, it's right over the Utah-Idaho border. Beautiful area. Happens to be right next to Preston, Idaho, which is where Napoleon Dynamite was filmed, if any of you are familiar with that film. Pretty crazy, silly movie from a few years back that, if you know Preston and visit Preston often, was pretty fun. But anyway, that's where I was Saturday and Sunday. I started to get emails halfway through the day on Saturday that there was a problem with the checkpoint on Saturday. I apologize for that. The course is set up by the school, and sometimes I miss something like that as I'm reviewing. It looks like the Saturday checkpoint never was online. So for a few of you who didn't even try to attempt the Saturday checkpoint, you've been given a gift. I've awarded everybody for the Saturday checkpoint the full 5 points. Okay? So in the future, just know that you don't need to panic about something like that. Don't need to get stressed out about it. A handful of you did the right thing. You just zipped me a quick email, and Frida, I think you were one of those that emailed me. I appreciate that. Once I was aware of it and got back into town, because Franklin has I had no access to internet connectivity in Franklin in the middle of nowhere. So once I got back into town Sunday night, I was able to update that, award everybody the points, and we should be in good shape. Okay? All right, Frida, since you're here, any questions or concerns about the work so far in the class? Anything I can do to help you with your work to this point? Are you feeling okay about things so far? I mean, do things feel like they're going along as good as they can for you? Good. So you're doing a good job. Appreciate you. And appreciate you coming tonight and participating in the session. That helps me out, so I really appreciate you doing that, making the sacrifice to be here. Really quick, just one more quick thing. If you aren't aware, which you probably aren't because I just barely completed the end of the grading for this last week, all work that's been turned in on time to this point has been graded for weeks 1 and 2. Some of the late work from week 1 still has not been graded. I can get that probably tonight or tomorrow morning. But all work that's been turned in on time to this point has been graded. So you should have a pretty good idea of what your score is so far in the course, having gone just over halfway through it to this point. If you have any questions about grading, let me know. Keep in mind a couple things about grading. First of all, if you don't get full credit, once again, for anything other than late work, you are always able to resubmit, edit, re-respond, add a response as far as the discussion board is concerned. Whatever you need to do to increase your score and then resubmit. And before the end of the class, I will have graded that and awarded some extra additional credit to you. So just keep that in mind. The other thing to keep in mind is sometimes the school sets up, and this was the case this time, where like test 1, for example, assignment 1, and the week 1 discussion board were all of a sudden they were timed out and they were locked out. You couldn't get back into them. As of tonight, I've reopened all the assignment, assessment, discussion board from week 1, and I've edited the week 2 parameters so that you'll have until the end of the course to complete all those different assignments, assessments, and discussion boards. So if to this point you have tried to go back in to, for example, add responses to a discussion board in week 1, or tried to submit an assignment and haven't been able to, I would encourage you to go back in now. All of those should be open and available for you to still submit work all the way up until the end of the course. Having said that, as I mentioned before, please don't procrastinate until next week at the end of the week. I mean, that's your prerogative. That's your right. You can I can't tell you how to do a course like this. You're the one paying to do it. However, it's my experience that sometimes when we wait till the end, we just aren't able to pass, and I hate to see that. I'd like everybody in the class to pass, and if you've got anything holding you back at this point, as far as not being able to understand, not being able to access the book, anything like that, please, sooner than later, don't wait till the end of the class, but sooner than later, be right in touch with me so that we can resolve those issues and you can get on track. Okay? All right, enough about that. Frida, you're in good shape. So, a lot of this information that we've gone over so far as review and things like that, not really as applicable to you. So let's move on and get to the meat. So tonight, as I mentioned before, we're covering Chapter 11. We've covered some different topics so far. We've kind of jumped around in the book, and we're doing it again. I think we covered like 12 and 13 in week 1, and then we covered 2 and 3 or something like that, or 3 and 4 last week, and now we're covering just one chapter this week, but it's Chapter 11. And Chapter 11 really gets to the crux of how we make decisions about investments and what types of investments we make decisions about. Last week we learned about mutual funds and ETFs and real estate a little bit. We didn't have time to cover a lot about real estate, but it was in the reading. This week, we're going to learn a little bit more about how you consider investments, some of the rules associated and regulations associated with investments. And so it's kind of the heart of investments in general. Once again, some of you are going to, get to this chapter 11, and say, oh, I'm not investing right now. This class is not really applicable to what I'm doing in my life right now. I don't have a job where I have a 401k or IRA, and I don't invest in stocks and mutual funds because I don't have any money to, right? That may be your response to what we're learning about so far in this class. But I would caution you to not think that this is something that you will never have applicability to, because most of us, not all of us, but most of us, no matter what our situation is, will at some point in our lives have access to some kind of retirement plan that holds investments. And some of the decision making associated with those investments will be on our shoulders, right? We'll need to make our choices. And the more informed we are, the better we understand these principles about investing, the better educated we are, the better a consumer we can be when it comes to our retirement planning. And 30 years ago, everybody had pension plans, and between pension plans and Social Security, they were covered. They'd work at the same place for 30 years or 40 years, they'd retire. And when they retired, they had a pension and Social Security, and they were taken care of pretty well in retirement. Nowadays, it's very rare to have a pension. Almost everybody has a 401k through their employer, some kind of retirement plan that's contributory, meaning something that we contribute to and we have to make the investment decisions about. Our parents and grandparents didn't have that. They had pensions where they had no choice when it came to what they invested in. So there's a good and bad issue associated with that. Pensions took the decision making out of you and I as consumers, and for many people that's a positive because then they don't make mistakes. But the negative is we don't have as much control, right? So we give up, the fact that there are guarantees associated with pensions, and we get more flexibility with the newer types of plans like 401ks. A big problem that I tend to see in my world, though, as a financial planner or advisor, is most people don't stay at their job for 30 or 40 years. Most people, on average, change jobs every 7 to 9 years, statistically now. And if you're changing jobs every 7 to 9 years, you never really get a lot of money in a retirement plan. And so it's highly tempting to take out whatever small amount is in your retirement plan to pay down debt or to help transition you to the next job or to pay a medical bill or a credit card off, those kinds of things. And what happens is somebody who's switched jobs a lot throughout their career gets to retirement, and maybe they only have that last 401k even available to them. That's it. And the problem with that is they might just not have nearly enough, to retire comfortably because they don't have a pension, right? We talked about that. Most people don't have a pension now. All they've got is their 401k or retirement plan through work, and then Social Security. All right. So point is, if you at all possibly can, we want to keep our retirement plans together, combine them. When we go from one employer to another, we want to combine them together. and we want to stay as consistent as we possibly can without pulling money. I mean, we got to treat that money like it's off limits. We can't touch it, okay? So that we can get to the point where we're at the door of retirement and we haven't squandered away all our retirement plans over all our career, so that we have something there for us. Now, the other side of that equation is, so that's the most important part, is that we're consistent, we participate, and even if we're switching jobs, we just keep consolidating them into the next plan, rolling them into the next plan, and keep them together and not ever draw out and keep contributing to them. So that's tip one. That's the most important part. Tip two is we need to make decent decisions about what we're invested in. If we tinker too much with our 401ks, sometimes we make really, really poor decisions as far as what we're investing, how we're investing. As a recent example, a lot of my customers and clients coming through 2008, which was a huge recession, right? A financial crisis in this country where the market went down by 45% in 1 year in 2008. Well, a lot of people experienced that and they sold out of everything right at the bottom and went into cash. Okay, and then just within the past few years, they've reinvested. The problem is they've missed out on all the rally over the past 7+ years that the market's afforded them. So if they'd have just held tight in a consistent plan with a consistent strategy with their investments, they would have recovered that 45% loss, plus they would have averaged over the past 10 years close to 6 to 8%, which is what we want to average in our retirement plans. If we average 6 to 8%, then we'll double our money every 10 years, okay? But if we're in that boat of, if we're in the group of people who sold everything off in 2008 because we panicked about the market, and I don't blame people who did this. I mean, it was a very stressful time. I had a lot of clients, even though I was right there to tell them, hey, don't do this, they still did it, right? Because it was just so stressful. But if we were in a boat where we sold out, or if we're in the party where we sold out in 2008 or 2009 right at the bottom, and we haven't reinvested, we've just been sitting in cash the past 8 years, we lost half our money and we will never get that half, that 40-45% back from the market, right? Because the market now is up significantly. So if we invest now, we're not ever going to make back that loss that we experienced in 2008. We needed to stay in our strategy, stay consistent with our strategy in order to make that back. Okay? So if we can stay consistent about contributing, consistent about rolling plans and combining plans instead of withdrawing at any point, and then finally, if we can stay consistent with our strategy and how we invest, if we just follow those basic tips or rules associated with retirement plans, we'll be in great shape. All right, so let's get me off the soapbox and get into the course content here for Chapter 11. So a couple different things. A lot of people, when they talk about investing, and I think I've mentioned it in this class, but a lot of people, when they talk about investing, they'll say, oh, I don't invest in it. I don't invest anywhere because it's all gambling. It's all like I'm going to, the casino, or I'm going to Vegas. And one of the things that you'll find out if you will put in the effort to investing and do your homework about investing is it is absolutely not gambling. Is there risk? Absolutely yes. Is it like gambling? Absolutely not. Not if you've done your homework, not if you're investing in good companies. Why do I say that? If I go to a casino, right, and gamble, the odds are against me, right? The odds are always in the favor of the house, or in this case, whatever casino company or casino I happen to be at, okay? If I invest in good companies, the odds are always, okay, in my favor, actually. So do you see how that's different from gambling? In gambling, the odds are always against you, okay? You're going to lose more than you're going to win. In investing, at least historically, in good companies, the odds have been in your favor and you win more than you lose. And let me give you a concrete example of that. Over the last 80 years in the stock market, investors have experienced, on average, 7 years of positive growth and 3 years of negative declines. Okay, so 7 out of 10 years, 70% of the time approximately, you'll be growing your money, and 30% of the time you'll actually go down. Okay, in a casino, you might win 40% of the time and lose 60% of the time. Some games get closer to 50%, and some games get closer to 30 or 20%. You lose more more of the time. So when somebody says to me it's like gambling when I invest in the market over the long term, I tell them gambling loses, right? You're more likely to lose than win. But in long-term investing over the last 80 years, you've never lost as long as, okay, and this is the key, as long as you're diversified and as long as you're long-term. And when I say long-term, I mean 10 plus years. And when I say diversified, I mean multiple positions, not just like two. Okay, that's not diversified. So I need a diversified portfolio, and I need time on my side. If I have those two things, historically I've never lost. Okay, it doesn't mean it couldn't happen in the future, but historically I've never lost if I have those two things. And there's nothing in Vegas that I can say I will never lose, right? That's gambling. Gambling puts the odds against you. Investing long term in a diversified portfolio always puts the odds in your favor. So they're very different. Now, is there a type of investing that is more like speculating or gambling? The answer is absolutely yes. And Frida, maybe you've been listening to the radio, or maybe you've been watching TV because you couldn't sleep in the middle of the night, and one of these ads has come on for like day trading or for penny stock trading, or maybe you've seen a tip online about a certain stock that you should invest in. Many times those positions are a high risk, high reward proposition. And many times those positions are more likely to go to zero than they are to go up. Okay? So we just have to know that. We have to know before we get in that if we're going to put all our eggs in a basket with a high risk, high return potential, that we could lose everything, right? And it could be more like gambling. But when it comes to core investing for the long term in a diversified portfolio, that's not speculating, that's investing, and that's something that is in our favor statistically every single time. Okay. One of the things we talked about last week with the case study is making sure that we have an emergency reserve or enough cash. This note here on this slide actually, states something that's also important, which is really long-term investing. You afford yourself the opportunity to do long-term investing if you have an emergency reserve and you have sufficient insurance coverages. Okay, if you don't have sufficient health insurance, for example, and something happens to your health, then all the investments can't be long-term because you got to pull them out to pay your health bills, right? So adequate health coverage, emergency reserves are what allows us. They're the cornerstone, and they're what allows us to participate long-term in investing. Frida, when you talk about junk investments, you're talking about, well, there's a couple different things that they use the terminology junk investments for. So they're junk bonds. Those are high yield bonds that are low rated, okay, that pay a pretty high yield. And the reason they pay a pretty high yield and they're called junk bonds is because they could go away, right? Those companies could go bankrupt and then you'd have nothing. I call penny stocks junk investments, but that's my own terminology. I think if you're investing in stocks that are like 30 cents a share or 50 cents a share, the first thing that you need to think in your mind is this is highly likely to go to zero and not very likely to increase significantly for me. Doesn't mean that it can't, right? But if you were to say to me, Frida, should I go buy the lottery? I'd say, well, highly likely that you're going to go to zero, right? That you're not going to get anything. But there is a chance that you could make some money. So it's not that you shouldn't do it. I'm not saying that I'm against the lottery or against speculating on investments or junk investments, as you mentioned, but you should only do it with non-core money that you're perfectly okay losing, and that you are going to be entertained in some way by participating because you got to get some kind of value, money or otherwise, out of it, or you shouldn't be doing it anyway, right? It's highly unlikely in penny stocks that you will ever make money, but there is a chance. And if there is a chance, of course, there's going to be millions of people who want to invest and speculate on it. Did that answer your question, Frida? I don't know what specifically you're referring to as far as junk investments, but when we talk about junk bonds, like I say, those are fixed income or bonds on the bond side that are low rated, high yield, high risk type bonds. And then I refer to penny stocks as kind of junk investments, just really high risk, high reward potential, but very unlikely to make money. Okay. All right. So this is pretty straightforward. This might be oversimplistic for most of you, but how do you get started with investing? How do you put together an investment plan? Well, first of all, you've just got to regularly allocate a portion of your earnings for investments. So if you work at an employer that matches money and puts money into a 401k for you and will give you some free money with a match, obviously that's kind of motivating, right? We rarely get anything good from our employees these days, our employers these days, excuse me, our bosses. So if we got to put up with management, if we got to put up with the company we work for, we should get some kind of matching program through a 401k or retirement plan. And if we do, we should definitely take advantage of it. It's also easy, right? So we can automatically invest through our paycheck, through our payroll, and the money's taken out before we ever see it, so it's not as hard. The psychology of it's a lot better because we automatically do it instead of waiting for the money to hit our checking account and then trying to put it back into a savings program. It's always harder to do that. So even if we don't have a work plan, my suggestion is for all of you, if you don't have a work retirement plan, but do have some income of some kind, gotta carve out a little bit to pay yourself. Start somewhere very small and then increase it the best you can as time goes on. But make it like any other bill that you have. You have a cell phone bill that you pay every single month, you'd never miss it. Make this a bill that you pay every month and never miss it, because it's that important that you get some savings put together for the future. Social Security will not be enough to maintain a decent lifestyle in retirement if that's all you have. Okay, so we know it's very important. We know we got to do this, but we've got to make it automatic. We got to make it consistent so that we don't have to think about it, because if you have to think or worry about it every month, it's unlikely to succeed. The other thing, and I think I mentioned this in this class before, but it might have been a previous class, so I'll mention it again. The third bullet point here is play invest first, right? Don't put your hard-earned money into a real stock investment until you have determined for yourself that you feel comfortable with stock investing, right? There's too many ways that you could make significant mistakes when it comes to investing, and there's so many resources now, free resources. Investopedia, which is one of the websites that a lot of us use for our discussion boards and for our assignments right each week as far as our research, that same site, that investopedia.com site, has a simulator for investing in stocks. So you can use play money and just practice trading in and out of stocks and watching their value go up and down. This will give you some experience with investing that I think is just so important, because what happens is some people invest unknowing or not knowing, that stocks bounce around as much as they do. And so what happens is they get kind of beat up by the value of their account going wildly up and down all the time. They think things are great when it's up high. They think things are horrible when it's down low, and it just emotionally beats them up. And so they eventually get kind of disenfranchised by it, and sometime when it's down, they just get out. Well, that's about the worst thing that you can do with stock investing or with investments in general. With investments in general, we talked about it before, but you've got to have a long-term time horizon. If you think short-term with your stock or mutual fund portfolios, they will beat you up, eat you up, and spit you out. You got to think long-term. And Frida, I think you had mentioned in a previous week that you've got some rentals or something like that, or did at some point. Maybe it was someone else in the class. But imagine as a homeowner or as a rental property owner, okay, that you were to get an appraisal on your property every day. So every day in the mail, they send you an official appraisal on your rental property. You would probably go crazy, because that rental property is going to bounce around up and down in value. And we think about that and we say, well, that wouldn't bother me though, because I'm a long-term investor in rental properties, right? I don't care if the value of the property goes up or down. I'm a long-term investor. But you'd be surprised how many people would bail on rental properties or any kind of investment property, real estate, if they were to get a valuation updated on a day-to-day basis, because it just plays with your emotions, right? If it goes down like 9 months in a row, you beat yourself up and you end up selling the property because you just can't handle seeing your value go down as much as it potentially can, even in real estate. But because we don't get those valuations, we don't worry about it, right? And Frida, you're exactly right. We don't check on that, right? Who cares what the value's done yesterday or today? We're more interested in the long-term value, right? And the long-term income associated with that property. Well, until we think about market investments the same way, we'll never be a successful investor. Because short-term stock investing, when you're paying attention to the day-to-day movements of stocks like a day trader does, will at some point sabotage your ability to think logically about your investments and not just get emotional and panic. Okay? The market makes people panic if they're paying too close of attention to what's happening in the short term, and they get their eye off the ball as far as the long-term prospect of what they're investing in and the reason that they invested, right, in the first place, just like you did with your property. Now, and you bring up a great point, Frida. If somebody approaches you with the right offer and it's high, right, it's somebody willing to pay above market value or just really, really great offer, maybe you take it, right? Even though you were long term, if you get some significant profit, right, more than you expected, it would be silly not to consider that and probably not to take it, right? I mean, that's something you probably ought to do. And once again, the same thing is true for a market investment at any point as well. It's funny, people will invest like about 2 years ago, people were investing a lot in biotechnology stocks. So these are companies that are trying to get new technology to basically solve the world's health problems, right? Biotech companies. And a couple years ago, biotech companies were just going crazy. You'd invest in a biotech company, and 6 months later, it was up 50%, 75%, 100%, 200%. I mean, it just seemed like you couldn't go wrong with biotech companies. Well, of course, that had to come to an end at some point. The last 6 months, or excuse me, the last year has been pretty bad for biotech as a general category. But it was funny because people who invested in biotech just said, well, I think biotech's going to be good over the long term. It'll probably go up by 10 or 12% a year long term. And then when they got up 50% or 100%, they got greedy, right? And instead of selling and taking some of their profits off the table, they got greedy and they waited too long, and then it cycles against you. And it doesn't matter if it's real estate or precious metals or investments in the market, all of them are cyclical. If you're up high and you could get a significant profit by somebody selling, somebody's willing to buy from you, I always encourage my clients, no matter what they're investing in, no matter how well they think it might do in the future, to consider good offers or good opportunities to take profit at any point, right? Because the worst thing we can do is hang on too long, right? It's okay to get out early. It's not okay to hang on too long. So if you get out too early and the value goes up a little more, that's okay, Frida, right? I mean, if that property went up a little bit more and you had gotten out early and got a great price and took a bunch of profit, that's just fine, right? But it's not okay if you were greedy and said to yourself, well, I'm not going to sell to anybody, even though I'm up really high. I'm not going to sell because I'm going to keep waiting for it to go up even further. And just ask your friends who were investing in a lot of real estate, highly leveraged real estate back in 2006 and 7, saying, well, this is never going to go down, right? And then in 2008 and 2009, it comes crashing down on people because they just got greedy, right? They just thought it would always go up. And that's just not how any of these investments work. They all go in cycles. So you have to be careful, right? And it doesn't mean you have to sell everything off. I mean, Frida, if you had, let's say, 3 rental properties and you got an offer on one of them and you could take a lot of profit, that's a great opportunity, right? Sell one off, and then you've diversified by default, by having some significant cash, and you can hold on to one or two and still feel fine about it because you made a lot during good times. Yeah, and you're not alone, Frida. That is definitely not the exception. That's what people in general do, right? We ride things up and then we ride them too long and they come back down. And we ride them back up and we buy in when they're high and we ride them back down. And even in real estate, people get beat up sometimes by having the wrong timing instead of just having a consistent long-term strategy. The folks who have consistent long-term strategy when it comes to rental properties, they do fine. They do great. It's the folks who don't know if they're long-term and end up buying and selling, more than they should and in wrong times that end up getting hurt, right? But if you're long-term, you're okay. All right, enough on that slide. Frida, can you see the what are your investment objectives slide? Sometimes it gets locked up if we sit on a slide too long, so I just want to double check. All right. So obviously before we go to invest, we've done some practice sites, we feel comfortable, we want to start investing, we've got some money in the bank that we've saved up for investing, but what's the next step? The next step is to make sure that we have properly determined, accurately determined for ourselves what the objectives are. If it's long-term, if it's retirement, that's a very different objective than somebody who's saying, I want the most current income that I can possibly get. Okay? The types of products that give you the highest current income are very different than the types of products that give us the most growth long-term, right? And add on top of that, the types of products for somebody who is very conservative and wants to be very conservative with their investments are very different than the types of investment products that are very aggressive, right? And so there's all kinds of different things. College, education expenses, tax planning. There's all kinds of different objectives that could play into what you're investing in. You've got to be very clear. If you're having somebody help you with your investments, you've got to be very clear with them on what your priorities are, right? And reiterate those priorities over and over again, because as much as I'd like to say that people in my business are, smart enough and they can figure it out, I have seen plenty of times where somebody has assumed something for somebody that was not correct, okay? And then it gets you in trouble, right? If your advisor is assuming they know what you need, that's never a good place to be. You want to make sure that they understand very clearly what your objectives are and goals are, and that they're meeting those goals. And if they're not, go find a different advisor that will. There's plenty of advisors out there if you're looking for investment advice. So you can get one that really understands what you're trying to do and does a good job for you. Or you can do it on your own, right? And either one of those is a decent option. I just want to make sure that you're a good consumer. If you're going to pay somebody for help, make sure they're giving you good help. All right, so how much will it take to start investing? And do you have to have a lump sum, or can you just invest systematically over time? So one of the nice things about an IRA or 401k or retirement plan of some kind is that usually it doesn't take any kind of initial balance. You can just start with any amount and start investing. But like if you were to open an IRA at Fidelity or a retirement account at Vanguard, which are two of the most, well, they are the biggest two sites for retirement planning as far as investments are concerned. If you were to open an account at one of those, they'd probably make you start with $500 or $1,000 in the account. So most of us don't have that kind of money just sitting under our mattress. Some people do. But if you don't have it sitting under your mattress, don't feel bad. What you need to do is set up an automatic savings program just into a savings account at your bank, right? Just a free account at the bank, and save into it each month until you've got enough to do that initial, required minimum with whomever you're going to use, right? And that's true for investment advisors too. Most advisors have some kind of minimum. You'll want to find that out right off the bat, because their minimum could be $1 million. So it's important to know, what their minimum is before you even start to engage, as far as getting information from them and starting to help, go through the process of planning with them. But the same is true for online brokerages, and online places that you can invest. They all have their own minimums as well before you can have an account and invest, and so you'll want to make sure you understand what that is. Different things you can invest in, of course. You could just invest in a common stock like Disney or Costco. There is something kind of fun and exciting about having a company that you feel very good about, that you're excited about, that you feel like is a well-run, good company, highly profitable, and something that you want to invest in for the long term, like Disney, for example. Some people really get excited about investing in Disney or Costco or Walmart or Target or Nike or Google or Apple or Netflix or Amazon. These are all companies that you can invest in their stock, and you could systematically buy more shares over time and increase your shares over time. Some of these companies pay you a nice dividend along the way. Others don't pay any dividend, but they definitely have great growth potential. And so, that's kind of a fun thing to do with stocks. Bonds are a little different. Bonds usually pay you some income, but don't really have much growth potential. So if I invest in a bond, like let's say I invest in a United States savings bond through the federal government, or a municipal bond through the state of Utah, which is where I live, or a corporate bond through a company like Walmart, these bonds are there primarily to pay me interest over time or income over time. So let's say I buy a bond and it pays me 3%, and I have $10,000 invested. So I get 3%, I get $300 per year for my $10,000 bond, which doesn't seem like a lot, but it's $300 more than I had before, right? And it's not that my $10,000 bond is going to go up in value much. It's just that I'm going to get that $300 in income. So it's a little different than a stock. It's for folks who are interested in interest income, and that's what they're trying to do. Then you've got preferreds and convertibles. I think that's beyond the conversation for tonight, but that's basically a hybrid stock or a hybrid bond. So a type of bond, a type of stock that's kind of a hybrid between the two. Then you've got mutual funds. All right, can you hear me now, Frida? Sorry for that. I think we had a break in my connection, actually. And so I apologize. Took me a while to get back on. Must be a blip in our, maybe we're having another thunderstorm here and something disconnected me there for a second. Okay, so we were talking about preferreds and convertibles, and we talked about mutual funds, exchange-traded funds, and exchange-traded notes, ETFs and ETNs. I don't know that the reading last week covered ETNs, and I don't know that once again, that it's not beyond kind of the scope of what we're dealing with here, but a lot of ETNs have to do with different categories of investments that just track a category or track an index. They don't actually invest. All they do is they allow somebody to invest in a particular index or category. So for example, I could have an exchange traded note for the price of oil, right? And it's not that that investment is actually investing in barrels of oil. All they're doing is guaranteeing me I'm going to get the results associated with what the price of oil does. So I don't want to like buy oil, right, and store it in my backyard. So I might invest in an exchange traded note or ETN that allows me the opportunity to benefit from what oil does, but not necessarily have to invest in it, the actual commodity. Okay, so that's an example of what an ETN can be. Last week you had mutual funds and exchange traded funds or ETFs as part of your reading, so I won't go over that. And then of course you've got real estate opportunities as well. Frida, it sounds like you've accomplished some real estate investment opportunities, and I applaud you for that. I encourage, even though I'm not a broker, I'm not a real estate agent, I don't have any dog in the hunt as far as any motivation to tell people, I don't make anything when people, in fact, sometimes I lose money because people take money away from me and my investments in order to invest in real estate. But I think it's an excellent idea to have as part of your overall financial picture some rental property or some real estate as well. And so I tell people, hey, I strongly support, a diversified approach, and real estate's a great part of the puzzle. Okay. Stocks, bonds, preferred securities. Here's some slides about each one of those individually. And we've got capital markets where you can trade different stocks. You've got the primary market and secondary market for stocks. Primary markets where you have IPOs, initial public offerings, like when a company goes public for the first time. A few years ago, Facebook went public, right? It was one of the largest IPOs ever until Visa came along, and Visa still has the record for the largest IPO ever. But basically, this is when a company goes from being a privately held company to a publicly held company and allows their stock to be issued and allows their stock to be traded in the public marketplace. That's an initial public offering, or IPO. If you listen to CNBC, if you read Wall Street Journal or any of the financial sites, IPOs get a lot of attention. They're exciting. It's a company that you can trade for the first time, like when GoPro goes public or when Facebook goes public. Everybody's excited to be able to trade that stock for the first time ever. Statistically speaking, IPOs usually go up significantly the first day and then come down after. So it's not a great idea to invest in IPOs the first day usually. There are some exceptions to that. Usually it's a better thing to either get in with the original underwriting of the IPO with an investment bank, but if you don't have access to that, which most of us don't, it's a better opportunity to allow the IPO day to run up and then buy it, maybe a week or two later or a few days later when it comes back down. Okay? So that's the primary market. That's where companies go from being private to public and issue their new stock. MasterCard was very good. Visa was very good. Google was excellent. Facebook was good for the first week and then crashed down. And then after it crashed down, has been phenomenal ever since. So it's not that you're going to lose money long term if you invest on the IPO. It's just sometimes that first day is not the right day. At least statistically, it's not the right day to invest, right? Wait for it to come down some, and then just like everything else, wait for it to be a better price and then get in. The secondary market just refers to the marketplace, like the New York Stock Exchange, where we trade securities among each other. What does that mean? Does it mean we're going somewhere and actually trading one stock for another with somebody? No. What it means is that somebody actually has to have the stock available for us to buy the stock. And when I say that, sometimes people say, well, really? There's millions of people just waiting to sell and millions of people just waiting to buy? And the answer is, in a good exchange like the New York Stock Exchange, it's yes. There are lots of willing buyers for every single security, and there are lots of willing sellers. So if I wanted tomorrow to buy Walmart, I would have no problem buying as much Walmart as I possibly wanted tomorrow. Okay, because there's just enough people ready to sell at any given point. And then if I needed to sell my Walmart tomorrow, there'd be millions, of shares available for me to sell as well. Because there's always somebody willing at a certain price. Now it could be higher or lower than what I want, but there's always somebody willing, to take on that stock. It's kind of like saying gold or silver, right? There's always a willing buyer for gold or silver. It doesn't mean I'm going to get the price that I want, but it does mean that somebody's always there ready and willing to pick up my silver or gold. It's such a liquid market. The same can't be said for some types of real estate, right? If I have a development property or a piece of raw land in the middle of nowhere, I might list it and not have any willing buyers, right? And I might put it down really, really low and still not have anybody that's willing to pick it up or buy it. But usually, as with anything else that has some inherent value, there's a price, right? There's always a price that if I get down to that price, somebody's willing to pick up my property. So even when the market was bad in 2008, 2009, 2010 for real estate, there was still always a price that people were willing to come in and buy. The problem was a lot of people were upside down, so they couldn't go down to that price or they would have lost a lot of money, right? So it can put you in a weird situation where you can't afford to get out. We talked about bids and asks. Bids are what we want to sell a security at, and ask is what we're willing to buy a security at. And when those bids and asks match up, that's when the trade actually happens, right? But really, it just happens in lifetime because there are so many people at any given price willing to go. There are lots of organizations. The most well-known is the New York Stock Exchange, but there are over 100 exchanges. So there are a lot of different exchanges. Most countries, most developed countries, and even some, third world countries have stock exchanges. They're usually regulated, and for our purposes here in this class, just be familiar with the Securities and Exchange Commission, the SEC. The SEC is the end all here in this country when it comes to enforcement and creation of securities law. Okay, so they administer securities laws here in this country. What does that mean? Well, the SEC is actually underfunded and understaffed pretty dramatically. So what they do is they basically have transitioned the work, the heavy work. They'll take high-profile cases like a Bernie Madoff, the SEC will. But most of your cases go to what's referred to as FINRA. Okay, used to be the NASD, but now it's called FINRA. And basically, it's a self-regulatory body of professionals that help to regulate themselves. And before you say, well, that doesn't sound very very good, having professionals regulate themselves, that sounds like a disaster waiting to happen. Actually, it's been highly effective because FINRA has the ability to get rid of somebody's licensing, right? So before you say, well, what can they really do? Well, they can fine you, they can kick you out of the industry if they find that you're doing things that you shouldn't be doing, not following the rules. In the end, they have to answer to what the SEC says that they should do, right? As far as what the rules are and what the penalties should be. But they're the ones, they're most of the boots on the ground is this organization called FINRA, FINRA. And you can look them up at finra.org and find all kinds of information about investment regulation. You can also do what's called broker check, which is an ability to look up anybody who's licensed as an investment person. And you could do this on me, right? Because it's public information. You could type in my name under broker check on FINRA, and it would show you my history as a licensed professional with investments. What it also shows is if you have any complaints or lawsuits against you for investments. And so before you work with somebody, you can always check what their background is if you're working with an advisor when it comes to investments. And that's something through FINRA that's, of course, regulated, and the oversight is the SEC, but FINRA's who actually carries that out. Okay? Lots of different laws and rules associated with investments, and basically these laws and rules come from problems, right? They're reactions to big problems that happen. If you look at the dates on these different rules, you'll notice something consistent, and that is that post-dramatic recessions, depressions, fraud, these rules or these big legislations come into effect. And usually when they first come into effect, they're too big and they go too far, and then we spend years trying to ratchet them back and trying to make them more moderate as far as what their approach is. But our initial reaction to 2008 and the recession, the Great Recession of 2008, and all the fraud that was going on was the Dodd-Frank rule, right? A lot of rules and protections associated with that because we didn't want to go through 2008 again. 2002 is a reaction to the dot-com bust, the recession of 2001 and 2002. 1934, 1940, we're talking about the Great Depression, right? We're talking about the Depression and the Great Depression before that. So just keep in mind that these rules usually come into effect as a reaction to something pretty significant and traumatic that the market goes through. They're usually not ahead of the game, right? So it's not perfect. It's not a great system. The regulations are highly effective when they're finally enforced, but it usually takes some crisis or somebody really breaking the rules, like a Bernie Madoff, before we get additional rules in place. And it's just because they're not a big enough organization to stay ahead of it, right? They don't have enough resources. We don't put enough tax dollars into it for them to know before a fraudster strikes what it is that they're going to do to strike, right? These people are pretty ingenious about how they skirt the system, and it's not until after they do it that we can come up with new rules to prevent those types of things from happening again. Okay, so just FYI on regulations. Not perfect, but it has been highly effective. It's just one of these things, though, that we do on a reactive basis, not a proactive basis. All right, any questions before we get to the 10 topics that you'll need to know for the test this week? Hope the recorded session works out because, like I say, we bumped there in the middle, and which probably created some problems. Hopefully it doesn't go black on or have 2 different sessions of recording or something like that for the recorded session. Frida, you might be the only one that got the right experience tonight with the session. We'll have to see after we wrap up tonight. Okay, so the 10 topics that you need to know for the test this week. The number 1 topic, you need to know who the SEC is and what do they do. We just barely talked about the SEC, but who are they and what do they do? We need to know about what the book has to say about investment objectives. There was a slide that we talked about different investment objectives like current income, long-term growth like retirement, mid-range goals like children's education, and then the bottom right was tax planning, right? So those are different objectives for investments. You need to be able from a list to identify what are potential objectives that the book talked about versus what are not potential objectives that the book talked about, okay, for investments. We need to know the difference between bear markets and bull markets. We hear a lot about a bull market and a bear market. You need to be able to memorize and understand, and it's not too hard, but a lot of people, you'd be surprised how few people really understand the difference between these two. But generally speaking, a bear market is a downward market and a bull market is an upward market, a good market, okay? So keep that in mind for the test. Keep in mind for the test what type of investor would want high current income. Okay, as a general rule. It's not always the case, but as a general rule, what type of investor, what does the book have to say, okay, in chapter 11 about what type of investor would be a high current income investor? Okay. Number 5 on the test, you'll want to know about maturity dates. Bonds have maturity dates, stocks do not. Just keep that in mind for the test. Number 6 on the test, you want to know what we talked about as far as stocks are concerned, whether or not investing was long-term or short-term. Okay, I differentiated between long-term investing and short-term speculation, right? So investing is one way and speculation is another. Just make sure you have that in your mind before you get to the test. Number 7 on the test is a repeat. It's not a repeat question, but it's a repeat topic from last week. On the discussion board last week, we talked about different types of orders like market, limit, stop loss. For number 7 on the test, if you just remember those 3 types, you'll get that one right. Number 8 on the test is a question about margin. Just know what the book has to say about what margin is. It's basically borrowing money to buy stocks. Make sure you understand what makes up the Dow Jones Industrial Average. So when we talk about what the Dow did today, what index, what makes up the index that tracks what that difference is? So how do we come up with the Dow going up 100 points or down 100 points any given day? What makes up the Dow? Just know what the book has to say about that. You'll get that one right. Number 10, deep discount brokers. So you've got difference between a brokerage, a traditional brokerage firm like a Merrill Lynch or Morgan Stanley, where you have a stock broker, right, that's trading stocks for you. Then you have online brokers like E-Trade, Ameritrade, those types of brokers. And then you have what the book refers to as a deep discount broker. And you'll want to know what the book has to say about that, and you'll get number 10 right on the test if you understand that. Okay, any of those topics that you didn't catch, Frida, or that I can repeat for you? Sorry, number 9. Give me just a second to get back to it. I asked you if you had them all, and then I got off the page. One sec. Number 9. Oh, I skipped number 9. Good call. Publicly traded companies. We'll need to know what publicly traded companies are required to do. What does the book say about what publicly traded companies are required to do? And actually, wait a second here. One sec. Yeah, that's it. Any other questions? Sorry, I was just thinking maybe I skipped some other questions, but I think we got all the rest of them. Any others that you don't have down? Number 5 was maturity dates. What types of investments have maturity dates? What types do not? Okay, so if you're thinking about stocks and bonds, which ones have maturity dates? Which ones do not? meaning like an end to the investment. So if I invest in Costco stock, is there a certain time period that I have to invest in it and then it's over? Or if I invest in Walmart bonds, is there a certain period that I invest in them and then they're over? We want to know what the book has to say about maturity dates for stocks and bonds. Do stocks have maturity dates? Do bonds have maturity dates? Do they both? Do neither? Just make sure you understand that before you get to the test. Any other questions, Frida? All right. Have a good evening. Have a good week this week. Thanks again for joining in on the session tonight. And let me know if you get stuck on anything so I can help out. Have a good night. Thank you. Appreciate that. Have a good night.